I'm going to give people another 15 seconds or so just to log in, and then we'll get started.
Okay.
Okay, good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Highlights of the 2025 Heckerling Institute on Estate Planning. As always, my name is Jonathan Shenkman, and I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not for profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcast. Today, we're privileged to hear from Kevin Matz, partner at ArentFox Schiff, based in New York. Kevin counsels clients on wealth transfer planning, drafting wills, trusts, gift and estate income and generation skipping transfer tax planning, charitable gift planning, and associated litigation, as well as corporate counseling. Kevin has advised clients on entity and succession planning, including the use of family limited partnerships, use of grantor retained annuity trusts, transfer to irrevocable trusts involving complex valuations, qualified personal resident trusts, irrevocable life insurance trusts, the use of charitable remainder trusts, and private foundations to further family planning and philanthropic objectives. Kevin is a fellow of the American College of Trust and Estate Council, chair of the New York City Bar Association Estate and Gift Taxation Committee, and the president-elect of the New York State Society of CPAs. He's also a prolific speaker and author on all the aforementioned topics. Today, Kevin will be speaking on highlights of the 2025 Heckerling Institute on Estate Planning. And with that introduction, I will now turn the program over to Kevin.
Well, thank you, Jonathan. Hello, everyone. Good morning. So today is, as you see, February 28, 2025, very significant, and we'll talk about it shortly. Today, I'm going to highlight or provide a summary of the highlights of last month's Heckerling Institute on Estate Planning. For those of you who are not familiar with Heckerling, it is the largest single gathering of estate planning professionals in the country. It's always held in January, usually middle January. Since 2007, it's been at the Orlando World Marriott, and its scale is unlike anything you will otherwise see in this field. Typically, they have about 4,000 attendees, more than 3,000 in person, another 1,000 via web. It's a week-long program from literally Monday morning until Friday at noon. It's a great way to network with other professionals. The I guess lobby bar area of the Orlando World Marriott is legendary. There's folks there a lot later than I am, but also just tremendous programming too. So you get to collaborate and network and connect with other professionals in the industry. Again, we're talking more than 3,000 in person, more than 4,000 total, but also wonderful programming. And what I'm going to do during this next hour is just summarize the highlights of the CLE and CPE and CE highlights of last month's Heckerling Institute on Estate Planning, but I'm going to bring it current to this morning, in fact, because there have been some very significant developments this past week, including just last night concerning the Corporate Transparency Act. And let me advance my screen, and there we are. So what I'm going to do is I'm going to talk about 16 different areas. And rather than go frantically through the slide deck is about 85 pages long, so I refer the materials to you. I'm really going to focus on the main points discussed on slides 1 and 2. And I'm going to start off actually going to item 7 because it's the most current, Corporate Transparency Act. And that again is the act of Congress that was signed into law back on January 1, 2021, came effective as of January 1, 2024, that provides that reporting companies have to provide information to FinCEN, which is a bureau of the U.S. Department of Treasury. And they have to provide information regarding so-called beneficial owners. And beneficial owners is defined as individuals, importantly, individuals who own or control at least 25% of the interest in a reporting company, or were able to exercise substantial control over a reporting company. Now, why is this so significant? Well, this again went into effect for newly formed reporting companies established in 2024 or later, would have to file at least last year with FinCEN within 90 days, unless an exception applies for disaster relief. That provision for newly formed companies is now 30 days here in 2025. For reporting companies that were formed prior to January 1, 2024, the due date for filing was January 1, 2025. Now you'll see January 1, 2025 is a date in the rear view window. Today's February 28, 2025, because I know a lot of folks who are going to be listening to the recording of this. So what happened in December? There was a nationwide injunction that was imposed by the Federal District Court in the Eastern District of Texas in the so-called Texas Top Cop Shop case. Federal District Court, Eastern District of Texas, that said we're going to enjoin the CTA, Corporate Transparency Act, from being enforced, and from any beneficial ownership information reports from having to be filed with FinCEN, and we're gonna provide that injunctive relief, not just on a preliminary injunctive basis, not just against with respect to the plaintiffs in the action, but also on a nationwide basis, So it essentially shut down FinCEN's ability to require to enforce reporting. There was then another case, also Eastern District of Texas, Samantha Smith case, that said the same thing. Now, these cases were appealed, the Texas Top Cop Shop case, and the question was, should there be a stay of the injunction pending further appeal on the merits? The Supreme Court ultimately in Texas Top Cop Shop said no, there should be a stay of it, and then eventually the Samantha Smith case followed suit. So that's where we were as of 8:17 p.m. last night, with one further development. So FinCEN then said, okay, we're going to give you a 30-day grace period. You have until, for the most part, by and large, till March 21, 2025, to file your BOI reports. We recognize that you didn't have to. It was all voluntary because of the injunctive relief that was provided. But we're now giving you from February 18th, rolling it forward, February 19th, rolling it forward to March 21. That is the D-Day. That's where we were as of 8:17 p.m. last night. Last night, again, for recording purposes, being February 27th. It all changed. It has all changed. FinCEN announced, and I'm signed up on a subscription basis for their alerts. So as of, I checked right before this webinar, it's still not appearing on their website, but I would assume that I would expect that it would be posted sometime later today. And they said, well, you know what? You don't have to worry about March 21st anymore, because although it's still the deadline, we're not going to issue any fines or penalties if you don't report by then. And let me read to you what they announced in their alert. Again, 8:17 p.m. just last night being February 27th. The headline, FinCEN not issuing fines or penalties in connection with beneficial ownership information reporting deadlines. Today, FinCEN announced, that's yesterday, February 27th, FinCEN announced that it will not issue any fines or penalties or take any other enforcement actions against any companies based on any failure to file or update beneficial ownership information BOI reports pursuant to the Corporate Transparency Act by the current deadlines. Again, that current deadline for the most part was to be March 21st, 2025. No fines or penalties will be issued, and no enforcement actions will be taken, i.e., that's a blanket waiver of penalties, until A forthcoming, so it's not here yet, interim final rule becomes effective and the new relevant due dates in the interim final rule have passed. This announcement continues Treasury's commitment to reducing regulatory burden on business, as well as prioritizing under the Corporate Transparency Act reporting of BOI for those entities that pose the most significant law enforcement and national security risks. No later than March 21, 2025, they actually put that in bold, FinCEN intends to issue an interim final rule that extends BOI reporting deadlines. So again, they're saying March 21 is off the table. They're not going to enforce it. Recognizing the need to provide new guidance and clarity as quickly as possible, while ensuring that BOI that is highly useful to important national security, intelligence, and law enforcement activities is reported. And FinCEN also says the following. FinCEN also intends to solicit public comment on potential revisions to existing BOI reporting requirements. FinCEN will consider those comments as part of a notice of proposed rulemaking anticipated to be issued later this year to minimize burden on small businesses, while ensuring that BOI is highly useful to important national security, intelligence, and law enforcement activities, as well as determine what, if any, modifications to deadlines referenced here should be considered. So a huge development last night. March 21 deadline is not being enforced. There's a blanket waiver of penalties, and FinCEN by March 21 has committed to coming out with further guidance, setting forth further deadlines, planning to limit the scope of who has to file, so if you have, especially domestic entities, you might not even have to file anymore, and then also seek guidance on how to make things more finely tuned via a notice of proposed rulemaking. Very significant development. So I wanted to address that first. Let's go back to item one, because this got a lot of attention to Heckerling, and as did the Corporate Transparency Act and BOI reporting. And this too has a significant further development literally in the last 2 days. Tax legislation prospects for 2025 and the fate of 2017 Tax Act. So the consensus at Heckerling was concerned, well, just to set the table on it, we have, of course, the Tax Cuts and Jobs Act that was enacted in December 2017, that while there are some provisions that are permanent, most of its provisions are scheduled to sunset after December 31, 2025. December 31, 2025. And in the estate planning realm, there was a doubling of the exemptions, of the exclusions for estate gift and GST tax purposes. GST, of course, shorthand for generous can be transfer tax purposes. That increased it from 5 million as indexed to 10 million as indexed. And that amount here in 2025 is $13,980,000. Which means, let's call it 14 million to make the math simple. It means that a married couple, for the most part, is able to pass up to $28 million federal basis between spouses, free of federal, estate, gift, and GST taxes. Now, that amount is scheduled to sunset after December 31, 2025 to half that amount. So instead of 14 million or 13.99 million, it'll be with indexing probably in the neighborhood of about $7.2 million next year. That's what the law provides as of January 1, 2026, if Congress does not act. What happened, though? Well, in the election in November, the Republicans basically had a sweep of the Oval Office in both houses of Congress. And we can look to history as to this. In recent history, when that last happened was 2017, and that culminated in the Tax Cuts and Jobs Act. And that was done through a process known as budget reconciliation. And budget reconciliation is very significant because it allows a budget to be established and allows for action to be taken by Congress with a simple majority in the Senate. And again, the Republicans control the Senate, and simple majority for this purpose, because they also control the Oval Office, and therefore the vice president would be able to cast the deciding vote in the event of a tie, means 50 votes. And that is in contrast to the ordinary rules of filibuster that requires 60 votes for action by the Senate in order to have legislative action. So instead of 60, you only need 50. And again, we look at the model of what was done back in 2017. In 2017, you had, for the most part, again, a few provisions were permanent, but including in the estate gift and GST tax realm. This also applies to the $10,000 SALT limitation cap. We had an 8-year patch put in. It's scheduled to expire December 31, 2025. And why was it 8 years? The answer to that is that's all that could be fit within the budget. And the budget was set at roughly $1.5 trillion over 10 years. $1.5 trillion over 10 years in 2017. So here we are in 2025. The Republicans had the so-called trifecta in the recent election. What happens literally 3 days ago, this week? We now have a budget resolution from the House of Representatives, and that budget resolution says that, okay, we're going to permit the deficit to be increased by up to not 1.5 trillion, which again is a comparable from 2017. I guess you got to adjust for inflation, cost of living adjustments, but rather by $4.5 trillion over 10 years. 4.5 trillion. That is nearly 3 times the roughly $1.5 trillion deficit cap under the 2017 Tax Cuts and Jobs Act. Very significant. Now, the consensus at Heckerling was, well, there's a lot of concerns in Congress, including among the Republicans, regarding the deficit. The two greatest contributors to the deficits are, or the two greatest spend items from year to year right now, not military spending, but rather number 1 and 2 are Social Security and debt service on the government's debt, interest on debt. And much of the discussion was, well, we have deficit hawks within the Republican Party and the like. And probably if we get an extension, and the consensus seemed to be, Austin Bramwell from Milbank stated, who actually used to work for for a short period of time for the Trump administration back in 2017 in U.S. Department of Treasury. His prognostication was 85% likelihood, and some of the other speakers thought it was even higher, seemed to express even higher confidence. But we're probably looking at a short-term extension. What I've heard the most, maybe 4 years, maybe 5 years. This completely blows it out of the water, this new development, because we're talking about tripling the cap. Now, granted, there are certain offsets, there are commitments that are involved that could be dollar for dollar reductions based upon a failure to actually have cuts in government spending and the like. But assuming that math works out, we're talking about something that is, even adjusted for inflation, well, more than double, but in terms of notional amounts without adjusting for inflation, 3 times what was done in 2017. Based upon that complete change in the playing field, I think we're not looking at just a short-term extension right now. I think we're probably looking at something much longer term. It would not surprise me, because of this development, perhaps the various components of the Tax Cuts and Jobs Act were to be made permanent. And there are various views have been expressed concerning whether or not that could be done, as far as how the scoring even goes into the 4.5 trillion over 10 years. But another huge post-Heckerling development of an item that was discussed there. So much of the planning that was centered around, the sunset, talked about where you have spouses, spousal lifetime access trust and the like, and you could do the planning there and various permutations, so-called splittable slats, which could perhaps not even have a spouse as a beneficiary day one, but perhaps have a protector add a spouse down the road. That being the concern, that with the Tax Cuts and Jobs Act scheduled to expire, there is a use it and lose it principle that's embedded in the in the principles involved for the exemption. Treasury in 2019 basically came out with final regulations that said, yeah, if you use all your exemption and you don't have something basically that is not a completed transfer for estate tax purposes, basically a string provisions, Section 2036, as in the case of family limited partnerships, and you're not trying to be too cute with a purposely failed grat or purposely flunking Section 2701 regarding certain rules concerning phantom gifts and the like. You're not trying to be too cute there. We're going to give you the benefit of the exemption, the higher the exclusions at the time of gift or time of death. And unless you have these string provisions provide, there's no clawback, there's no deferred estate tax, which set things up to what? Set things up to a posture of you, if you can afford to, use the exemption now, or otherwise lose the benefit of the doubled exemption. And that was the key principle. There, use it or lose it. If 28 million is too much to give away, maybe what you do is instead of gift splitting, you use one spouse's exemption, at least lock in using the entire 13.99 million amount here in 2025. Well, again, dynamics have changed. Another dynamic, there has also been proposed a death tax repeal bill recently, which has been signed on, I'm told, by more than 200 members of Congress. Again, you need a lot more to get anything passed. Do I think that's going to pass? I don't think that's going to pass. But again, it's another chip to add to the bargaining table for negotiations. But this new expanded cap and the way it's potentially scored, that's just a game changer. And we're going to be hearing a lot more about that in the coming months. The consensus at Heckerling was any legislation would not get done until probably close to the finish line of the year. That's just the way Congress is. We look back at 2017, Tax Cuts and Jobs Act got signed in late December or second half of December. I think about December 20th of 2017. Maybe looking at something similar to that. But things seem to be hurrying up a lot faster now, especially with this new development literally of this week. So something to watch. And again, an item that was discussed very heavily at Heckerling. Just get my phone just so I can monitor the time. I know we have an hour together. So another item that got a lot of attention at Heckerling, marital trust planning, in particular, the Annenberg case and the McDougall case. People say, well, why? What's so complicated about marital trust planning? What was new about it? Well, we had two new cases that came out last year. The Annenberg case, McDougall case, that deal with what happens where where one spouse dies and leaves wealth to the surviving spouse in our favorite form of marital trust, the qualified turnable interest property, or QTIP trust. And that, of course, qualifies for the estate tax marital deduction. And the big event, so what that does is that it has to provide income each year solely to the surviving spouse. There could be distributions of principal, but any distributions of principal could be made only to the surviving spouse. And if you do that and you report it as such on an estate tax return, you then are able to get an estate tax marital deduction. It allows the first spouse to die to control who gets what on the second spouse's death. You could, of course, give testamentary powers of appointment to the surviving spouse, but you don't have to. It allows for absolute control by the first spouse to die concerning who gets the remainder interest in the QTIP trust when the surviving spouse dies. But there's a flip side to it. Code has a provision called that's Section 2519, Section 2519 in the Revenue Code that says, okay, we're going to give you the benefit of this marital deduction, but you can't do anything that compromises the setup that you have here and the regime that you have here. So if you, surviving spouse, if you make a gift of your income interest, again, the surviving spouse gets all the income each and every year, at least payable at least annually for life, and you gift it away to anyone, we're going to deem that basically on a phantom transfer basis, we're going to deem it to be a gift of the remainder interest. And if there's $100 million in the trust, and that's the remainder interest, in addition to the ordinary gift tax principles that would apply to the gift of the income interest, we're going to deem you to be making a gift of $100 million, even if you didn't. So 2519 is a very blunt instrument. And that's what the IRS invoked in the Annenberg case, the McDougall case. Annenberg case, there was one key difference in the facts. So Annenberg case, you had this surviving spouse, and she then got together with the kids and said, okay, let's have this plan here. And essentially the plan is, we're going to terminate the trust. Kids, you're going to consent, termination of the remainder interest. It's all going to go to me, the surviving spouse. And then what I'm going to do is I'm going to then sell the assets, or a good chunk of the assets that I've received, over to a trust being established for you. And you'll pay for it. Trustee will pay for it, issuing a promissory note at the applicable federal rate. Now, why is it advantageous to the kids? Well, if the surviving spouse lives a long period of time, the remainder interest doesn't get paid out to the kids until way, way, way down the road. Again, in order to have a Q-tip marital trust, the only beneficiary during lifetime the surviving spouse can be the surviving spouse and no one else. So, the kids consented to this because there was a plan in place. IRS does not like plans, and they've been successful, especially when spouses are involved, serving as straw persons. The Smaldino case, going back a couple years ago, is an example of that. And the IRS said, we're going to deem this to be a termination of this Q-tip marital trust. And Section 2519 applies, and therefore the entire amount is subject to gift tax. Pay up now 40 cents on the dollar. So there was litigation on this in the tax court. The decision that came out in May of last year, tax court held in favor of the taxpayer, in favor of the surviving spouse, saying, well, there was a transfer. There was a transfer, which could potentially trigger Section 2519. But who was the transfer from? The transfer was from the marital trust, which is deemed to be owned by the surviving spouse. To whom? To the surviving spouse. And we're not going to be concerned with the fact that maybe there was a subsequent transfer. Court said we're not going to look any further. There was a transfer from the deemed spouse, the Q-tip marital trust, to the surviving spouse. It may have been a transfer, but it's not a gift unless the transfer is from one person or deemed person to another person. Because it was from effectively the surviving spouse in trust, the surviving spouse individually, there is no gift. 2519 does not apply for that reason. Taxpayer wins. McDougall case had similar facts, but the IRS was a little bit more clever in how they structured it, their arguments. And in the McDougall case, the IRS made the exact same thing. It was the husband who was the surviving spouse here, a gentleman by the name of Bruce McDougall. And the IRS said, okay, hold on a second. So we're making the same argument here. And the tax court, again, citing the Annenberg case. McDougall case came out September 2024. Annenberg case was, Annenberg case was May 2024. IRS made the same argument. Court said, we've already decided this. We decided about 4 months ago in the Annenberg case. Taxpayer wins, 2519 doesn't apply. But hold on a second. The IRS is making a second argument here. And that second argument is that there was a gift by the kids to the surviving spouse. How so? Well, the kids consented to the termination of the Q-tip marital trust. And in doing so, they surrendered all their rights in the trust, remainder interest, to their dad. And yeah, their dad may have gone ahead and then sold assets that were in his own name over to a grantor trust for the benefit of the kids, but we're not going to collapse those steps here. Bottom line is, looking at the form of it, the kids gave up a right they didn't have to give up by consenting to the termination of the Q-tip trust and the transfer of the assets. And because they gave up their remainder interest, we think tax court said it's a gift. Now, we question, what's the amount of the gift? I believe there's about $60 million in the trust. Is it up $60 million? What if there are powers of appointment that the surviving spouse has that could essentially divest the remainder interest of children of what they would otherwise receive in favor of someone else? How does that work? Not an issue for the court. Court said it's a gift, and from what I understand, this is continuing litigation. There are depositions dealing with the valuation issue of how much that gift is, but very significant. And that was sort of an overarching theme, as far as the IRS has been very aggressive, and has been making arguments that, by consenting to something, waiving one's rights, failing to object to actions by trustees, could also be in the context of decanting potentially, that's a gift. And the IRS is saying, well, we're not going to decide what amount it is. That's to be determined. But if you can figure it out, it could be everything in the trust. $100 million trust could be that. Valuation principles will apply. Now, that actually is a principle that was discussed heavily at last year's Heckerling concerning a chief counsel advice. I'm going to just jump down to item 6. And that chief counsel advice is 2023-52018. And it was a ubiquitous item of discussion, completely pervaded this year's Heckerling Institute on estate planning as well. And that chief counsel advice, well, let me just tell you what a chief counsel advice is. And I'll tell you what it is by telling you what it's not. It's not a regulation. It's not a revenue ruling. It's rather advice from the IRS's national office to examining attorneys and auditors in the field in the context here of a gift tax audit as to from a litigation perspective. And Stephanie Loomis-Price, in the concluding session of Heckerling, did a wonderful job framing it. This is a litigator's position. This is not a revenue rule. This is simply a litigator's position, the litigator being the IRS, as to what they think the gift tax consequences are of giving up interest in a trust. That's CCA, Chief Counsel Advice 2023-52018. It was the gift tax consequences of modifying a grantor trust to add a tax reimbursement clause. Now, just to set the stage there, we estate planners love planning with grantor trust, so-called intentionally defective grantor trust, irrevocable trust that are a grantor trust. Why do we love it? Because it gives us and our clients the best of both worlds. We plan with a trust that is designed to be outside of one's taxable estate for estate, gift, and GST tax purposes, the other side of the so-called proverbial tax fence. But for income tax purposes, it's still one and the same as a grantor. And that produces two very significant consequences. First consequence, it means that under Revenue Ruling 85-13, if you have transactions between the grantor and the grantor trust, they're taxed nothings. They're disregarded. If I sell assets, just like what was done by the surviving spouse in the Annenberg and McDougal case, to a grantor trust, and it's paid for with a promissory note, does the sale generate capital gain? No, because it's selling to oneself, and Revenue Ruling 85-13 says, don't recognize. no realization on a sale to oneself between a grantor and a grantor's trust. What about the interest on the promissory note? Does that produce taxable income each and every year? Not if it's a grantor trust. Again, revenue ruling 85-13, it's a tax nothing. But it's the other side of the tax fence for estate, gift, and GST tax purposes, which means all the growth occurs outside the tax fence, even though you could have transactions with it that are tax nothings. Another consequence is because it's a grantor trust, grantor, as long as the grantor doesn't give up a grantor trust trigger, bears the income tax consequences of the assets in the trust, which means, let's say there are sales of securities, let's say there's interest, there's dividends, other sources of income. Is the grantor trust itself taxed? No, it's the grantor who's taxed on it. And Revenue Ruling 2004-64 says that's simply tantamount to the grantor discharging his or her own income tax liability. That's not a gift. Economic consequences of that is a tax-free gift year to year. You could be paying $1 million of income taxes on the gains generated by sales in the intentionally defected grantor trust. And does that produce any tax, any gift? The answer is no, because Revenue Ruling 2004-64 says it doesn't, because it's the grantor's own obligation. It's a grantor trust. Great results until you find a grantor who says, I don't want to pay my kids' income taxes anymore in the grantor trust. I'm tired of it. I'm exhausted of it. I'm going broke. I need to swap in, swap out assets, maybe borrow from the trustee for that. I don't want any of that. I want to turn off, well, not turn off the grantor trust trigger, but do something different. I want to add a trustee reimbursement right that doesn't exist under this particular trust. That was the case, situation, this CCA. Add this tax reimbursement right that didn't previously exist so that the trustee in its discretion can reimburse me. And Revenue Ruling 2004-64 says, as long as that's done without an implied agreement or a situation that exposes the grantor but the assets in the trust of the grantor's creditors under applicable state law, you don't have any estate tax risk associated with it. That's what was done. There was a petition to modify the terms of the grantor trust to give the grantor a reimbursement right that previously didn't exist. And the IRS National Office, in providing guidance in the field to its gift tax attorneys and auditors, said, you know what? Our position here is that is a gift by the beneficiaries of the trust because they consented to this modification. They didn't have to. Because they consented, they gave up their rights effectively to add their dad, the grantor, as a beneficiary, and he previously didn't have an interest. It doesn't matter that dad might have said, if you don't consent to this, I'm not going to make any more transfers to you, either during your lifetime or in the terms of my will at death. Doesn't matter. That's not for money or money's worth. IRS National Office and CCA says there's a gift. How much is a gift? Well, there was some loose language in the CCA that says if we can't figure out the amount of the gift, it's potentially a gift of everything. Ouch! See, $100 million in a trust, you provide this reimbursement, add this reimbursement provision that doesn't exist either under applicable provisions of state law, such as New York has, the default provisions, or under the terms of the governing instrument. And all of a sudden, there's a massive gift. The CCA then goes on and says, well, we think that ordinary valuation principles should be able to determine the amount of this gift. We don't know what it is and the method, but, it's up to the taxpayer to figure it out and propose it, and ultimately the IRS will review it. So the penumbra of that, was pervasive throughout Heckerling. Now, I will tell you a couple of things. So grantor trust planning, number one, this ordinarily should not be an issue. So in the great state of New York, we have a default provision that says that if you have a grantor trust, and even if it's silent as a default, unless you override, there is a reimbursement provision that authority that the trustee has, unless you negate it, so the trustee can reimburse. And also that doesn't cause it to be deemed a self-settled trust for gift or estate tax purposes or creditor rights purposes. In addition, if you have a state that doesn't have that, you could build in the right to reimburse under the terms of the trust instrument. I'd be a little bit concerned with exercising that reimbursement right, too many times, because then the IRS could say this kind of like sounds like an implied agreement, and maybe a death occurs. They might assert that Section 2036 applies, but you could have that right in there as a safeguard. Even if you don't have that, there's a terrific technique: loans from the trustee to the grantor. You have to bear appropriate interest. Trustees are fiduciaries, so maybe do a little bit more than AFR at reasonable commercial rates. Because it's a grantor trust, there's no interest income to be picked up each and every year, so there's no tax friction from that. The liability that's produced reduces the size, effectively reduces the grantor's balance sheet for estate tax purposes. So that's the way to do it. Not modifying grantor trust, but the IRS, basically its national office and CCA, put everyone on alert that that is the position that they're taking. And whenever there's a valuation issue, and they're going to be very aggressive, again, from a litigation perspective. And they moreover said in the CCA, well, the facts here involved a consent by the beneficiaries to a trustee's proposed action that effectively reduces their interest. But we, the IRS, think that can apply, this same principle would apply not only if there's affirmative consent, but also if there's notice to the beneficiaries and a failure to object, or perhaps even the context of a trust decanting. So lots of concern stemming from the IRS being very aggressive here. Again, valuation issues, what's an interest worth here and what's the value of what was done? What if there are powers of appointment that could potentially divest a beneficiary? I guess that enters the valuation mix. Something that was alluded to in the CCA, what if that adding a beneficiary, dad is a beneficiary of a discretionary trust where the deemed transferor, the kids, are still beneficiaries? Isn't that a self-settled trust to that extent as to the kids? And if it's a self-settled trust, there's a revenue ruling 76-103 that says that it's not, depending on applicable local law, unless you have asset protection trust jurisdiction that applies, that's not even a complete gift until the actual reimbursement occurs. And if reimbursement occurs, well, does that create a state tax inclusion risk on 2036A1? But maybe not, because maybe you have the bona fide sale exception apply, independent trustee, lots of applications here, but that got a lot of attention at Heckerling. We had some Supreme Court decisions. Item 4, you notice I mentioned litigation. There could be a lot more litigation happening because it's now initiated actually here by taxpayers. Because by virtue of 2 very significant Supreme Court decisions that were handed down during 2024, it's now a lot easier for taxpayers to challenge tax regulations. The Loper-Bright case and Corner Post. Background here is, for 40 years, since 1984 through 2024, there was what was known as the Chevron doctrine, And that doctrine says, from the Chevron case, Supreme Court decision 1984, is where you have an administrative agency that's construing an ambiguous federal statute, we, the courts, need to defer to the administrative agency as long as it has a reasonable construction in the statute. And it might not necessarily be the best construction, but as long as it's reasonable, the courts are supposed to defer to it. And the administrative agencies construction will prevail. Now, there are always exceptions when the argument is made and is upheld by a court, that construction is not reasonable. Think in terms of the situation involving grant to retain annuity trusts, grats, and the so-called Walton Grat case and like circa about 2000. But by and large, as long as it's a reasonable construction, it has to be sustained. And that was Supreme Court precedent. And what happened, Loper Bright? Loper Bright says, we're the Supremes. We're the Supreme Court. Precedent, we recognize precedent, but we can throw it out the window. We can overturn that precedent because we're the Supreme Court. No one else can do it, but we can. And we don't like this rule. We think it's a bad rule, and we think that courts should be allowed to scrutinize statutes, ambiguous federal statutes, and reach a conclusion, because it's a judicial function, as to what the best construction is, And the administrative agency, they're just a litigant. That's their position. They are not to be given any deference whatsoever. So completely changes the field concerning the ability to challenge federal tax regulations. It all gets looked at not from the standpoint of has the administrative agency posited or put forth a reasonable construction of an ambiguous statute. Question becomes, what is the best construction of the statute? Administrative agency, you're taking your position. Opposing party, plaintiff, you're taking your position. If it involves taxes, it's going to be a taxpayer taking that position. The court de novo has to resolve that. And moreover, in corner posts, question is, when does the action need to be brought by the plaintiff? What if you have a statute that was construed by administrative agency 20 years ago, way beyond the statute of limitations, one would think? Well, it all depends on when the statute of limitations begins to run. And the corner post said, the Supreme Court said, you look at when the injury occurred to the plaintiff, to the private individual. And only then, when the injury occurs, the statute of limitations begin to run. And when does the injury occur in this context of taxes? Well, it's when the IRS, for the most part, issues a notice of deficiency or takes some action that asserts that you're going to have to pay more taxes than you otherwise would based upon this construction. Only then does the statute of limitations run. So long and short of it, a good deal of discussion at Heckerling concerned, you're probably going to be seeing a lot more challenges to federal tax regulations by virtue of these two recent Supreme Court decisions in 2024, because statute of limitations is going to be open, and the ability to overturn an administrative agency's, the IRS's, Treasury's construction of an ambiguous statute has become so much easier because it's a de novo analysis with no deference whatsoever. Chevron deference is now dead. A category of litigation. Now, where the IRS has been very successful, and this is going back to really the late 1990s, early 2000s, is Section 2036 of the Internal Revenue Code. This is item 5 right now on the key developments discussed at Heckerling, and that's in the context quite often of family limited partnerships. It could also be family limited liability companies, FLLCs. And the situation presented itself in a state of Fields, which involved I won't say a deathbed, but it was a transfer via a power of attorney given by the transferor, a lady by the name of Mrs. Fields. No, not the Mrs. Fields from Cookies fame. I wish, but nevertheless, the name of Mrs. Fields, and acting via her grandnephew's power of attorney. The grandnephew basically came up with a plan, which occurred roughly 30 days before his great aunt died, when she had severe Alzheimer's, and he basically was the sole party signing all the documents to create a family limited partnership. And he was a general partner through an entity that he formed. He contributed $1,000. It's not a tremendous amount. Acting through the power of attorney that his great aunt gave him, Mrs. Fields had transferred over $17 million to this family partnership. So think capitalization, limited partner over 17 million, general partner only 1,000. Not really a big pooling of interest there, right? And she died 30 days later. She took back a limited partnership interest. And on the estate tax return, the position that was taken by the executor, who was also the grandnephew, a gentleman by the name of Mr. Milner, was, well, what did Mrs. Fields own here? Did she own the $17 million, more than $15 million, by the which was in marketable securities? No. She held a limited partnership interest in this entity. And our appraisers say, well, limited partnership interest is not very liquid. You can't get out of it. You can't control distributions. There are discounts for lack of control, lack of marketability, totaling 36.25%. Through that handiwork, took position that $17 million got eroded down to $10.8 million by interposing this family limited partnership within 30 days of death. The IRS, needless to say, was not amused when the audit occurred. And they challenged it. They challenged it under the chief weapon, challenged the use of family limited partnerships in such contexts, Section 2036 on the Internal Revenue Code. And Section 2036 has two separate provisions and then a very significant exception. Two separate provisions. 2036A1 says that if you transfer property and either expressly or implicitly you retain the enjoyment of that property, that's a trigger for estate tax inclusion under 2036A1. Then Section 2036A2 says, well, if you transfer property to an entity, and even though you don't retain enjoyment, you retain the right to designate either alone or in conjunction with other persons. So not just oneself, but it could having control, but in conjunction with other persons. And the tax court in the state of Powell case 2017 says that's what the statute says. That's what it means. Alone or in conjunction. You could have estate tax inclusion there. Now, the saving grace, where taxpayers quite often will win, where they do win, is basically a factual test based upon the so-called bona fide sale exception to Section 2036. And long and short of it, bona fide sale exception looks at two things. Number one is their proper maintenance of capital accounts based upon the pro rata allocations for properties transferred. And then more significantly, is there a substantial non-tax purpose in connection with the transferring property to this entity? And substantial non-tax purpose, courts going back to the Bongard case in 2005, have been telling us, it's a real purpose at the time of transfer, not post-fact, post-transfer explanations that are concocted on a theoretical basis as to why there was a benefit. But what were the real reasons at time of transfer? And this involves evidence. It involves development of facts, involves testimony and introduction of evidence concerning that. So tax court looked at it. They said, well, Section 2036A1 applies here. Why? Because Mrs. Fields was acting through her relative, her grandnephew, via a power of attorney. And it was understood because all the documents, the limited partnership agreement, and the interest on behalf of both Mrs. Fields as limited partner and also the general partner entity, which Mr. Milner owned, which contributed only a de minimis amount of $1,000. We think that it was both expressed and implied that if Mrs. Fields needed the money, she would get it. whenever she wanted it, and would apply not only during her life, and again, she made the transfer ultimately only 30 days, but roughly 30 days before she was to die and had severe Alzheimer's at that time, but following her death, if amounts needed to be paid out in bequest, including to the primary beneficiary of her estate, which was Mr. Milner, or if amounts needed to be paid to the IRS to fund estate taxes, those funds would be available as needed. And we think the court said both express and applied. We think there was retained interest on 2036A1. Court then said 2036A2. Besides that, look at the estate of Powell case, 2017 tax court decision. This actually itself was same analysis was also set forth in the tax court memorandum decision, the state of strategy from 2003. I'd say the Turner would note that the Turner case from 2011, 2012 said it as well, that Mrs. Fields, as a limited partner, had the ability at any point in time to join together with the other partners, specifically the general partner here, to liquidate the entity. She could also, and that is an estate tax trigger under 2036A2. See Estate of Powell 2017 full tax court unanimous decision in that regard. So what did Mr. Milner, the executor, then argue? He said, hey, hold on a second. Yeah, I hear you, 2036, 2036A1, and 2036A2, but there's a bona fide sale exception 20 to 2036, and if I show you a bona fide sale and the evidence supports it, taxpayer wins. And here we have 4 reasons why there's a bona fide sale. This is done for credit protection reasons. We were concerned for financial elder abuse. There were documented. There was a case about 5-6 years before Mrs. Fields died where that was a concern. We were concerned that the power of attorney would not be honored, and also this provide a way to for continuation of management of assets. And the court looked at it and said, you know what? These are theoretical justifications. We think that you did this for one reason, for the discounts, not for a substantial non-tax purpose, but to save taxes. And that isn't good enough. That doesn't qualify you for the bona fide sale exception. Yeah, there may have been another partner, but there was not a genuine pooling of interest, so to align with those cases where the bona fide sale exception has been applied, because successfully invoked because of a pooling of interest. Putting in $1,000 is de minimis. That's not a pooling of interest. You can't show that there was a change in investment strategy. You can't show that this was needed to prevent interfamily disputes, such as in the Schutt case, going by circa 2004. Taxpayer fails to make its burden, and the government wins. And beyond that, stern admonition, it's not simply a matter of nothing venture, nothing gain. What the court then went on to hold was, well, we're going to impose penalties, a 20% penalty for negligence, disregard rules and regulations, because we think you should have known, Mr. Milner, that it was unreasonable to take the position that you can convert a $17 million asset into $10.8 billion just by interposing a family limited partnership 30 days before death. And Mr. Milner was saying, but hold on a second, I relied upon advice of counsel. Well, the evidence didn't show that he ever asked counsel about this, an estate planning lawyer or other advisor about this. And there are also documents and evidence that showed that his own lawyer was reaching out to the appraiser saying, how can we get a bigger discount? How can we get a bigger discount? Not a great fact. So that's what happened there. Now, a few other items, because my time is running short. Connolly, Supreme Court decision, buy-sell agreements. So we had a lot of action, Supreme Court. Bottom line is, if you have estate tax issues, a redemption agreement is not the way to go, because the Supreme Court in Connolly resolved a disagreement between the circuits that said that if you have a stock redemption agreement, you do not get an offset, and you have life insurance that's funding it, that's funding the stock redemption agreement, you do not get an offset for the obligation to pay off the estate to pay out the interest. So instead, you're going to see a lot more discussion of this and people using, when estate taxes are an issue, cross purchase agreements, including potentially life insurance LLCs, which could achieve that result. Other cases, Huffman case involved an option agreement, price less than fair market value. Section 2703 applies there, unless you can show that you qualify for the exception, including because you have an arrangement that's comparable to what's done between unrelated parties at arm's length. Facts of Huffman: you had a son, Chad Huffman, purchase for $5 million under an option agreement, interest in an entity that was worth over $31 million. The IRS said, 31 minus 5, that's below market purchase. That's a $26 million taxable gift right there. Please pay up at 40 cents on the dollar, gift tax. Taxpayers said, hold on a second, we had a binding agreement. And this was done pursuant to the agreement, and that controls. But the IRS then responded, well, if you have an agreement between related parties, Section 2703 is a weapon to disregard it, and you have to meet certain tests, including that you have to show that the agreement was comparable to what's done between unrelated parties at arm's length. Taxpayer was unable to establish that. Few more items. I will address this very quickly in the last minute or two that I have. Final regulations of basis consistency reporting. This concerns the IRS Form 8971. We had proposed regulations that go back to 2016. We had a much more favorable view concerning what needs to be reported. Bottom line is that there used to be a rule that there was a zero basis rule. If you failed to report certain items, on the Form 8971, the basis information reporting report that's due 30 days after you file the Form 706 estate tax return, that has been largely eliminated. There's also much more favorable rules concerning what information you have to provide on the Form 8971 Schedule A to beneficiaries. You simply have to show what's actually distributed to them as to what could potentially be distributed to them, and there's a reduction in the extent of notices that need to be provided. Simply now coinciding, simply have to provide further Schedule A's to subsequent transfers only when the transferee is itself a trust. Final regulations, GST tax relief provisions, basically the 9100 relief that we have that says that if you fail to make an allocation of GST exemption, or you make a mistake, and time has passed, you have to apply to the IRS and basically explain why you made the mistake. Sometimes have an advisor fall on their own sword and explain it. An 8100 relief, the IRS has discretion to grant relief. They've effectively codified that, but made it very clear that they will not tolerate being whipsawed, so that if the situation is that an opt-in or opt-out of GST exemption wasn't made, and the IRS is of the view that that was done in part to basically keep something from coming to the IRS attention until after the gift tax statute of limitations runs, and then after you're seeking that relief, they need to know via affidavit exactly why that was done, and if they think they're being whipsawed, they will deny it. Planning retirement benefits on Secure Act, Secure 2.0, we finally have final regulations on Secure. Importantly, in the case of beneficiaries, designated beneficiaries who were subject to the 10-year rule, they were given waivers of excise taxes for each of the past few years. Separate notices that came out in 2022, 2023, and 2024. Those waivers were good until we finally had final regulations. Well, we now have final regulations, which means that even though taxpayers, or even though there doesn't have to be a makeup or required minimum distributions to those designated beneficiaries subject to the 10-year rule for taking their, there doesn't have to be makeup for prior years. Beginning in 2025, you have to start to receive your required minimum distribution, your RMD, each and every year. The discussion regarding business succession planning. My partner Tom Abendroth did a wonderful presentation there. There's also a great presentation That was done by Ellen Harrison and another panelist concerning the use of purpose trust, sometimes using 501(c)(4) organizations, similar to what was done in the Patagonia model, which essentially put this on the map. Discussion of portability, use of both spouses exemptions. Clarity Red, wonderful presentation, dealing with, among other things, advantages of portability, using Clayton Q-tips, defer estate tax decisions relating to the extent you fund either a marital trust or flipping over to a family trust until you file the estate tax return, which could be done with extensions up to 15 months after death. Discussion of various state law developments concerning the use of no contest clauses. Basically, they're all over the map. You have to review, research what particular state law applies. In some cases, they're respected. Other cases, they're not. In some cases, you could have challenges to that are made to remove a trustee, possibly being embraced and sustained as being violative of a no contest clause, which could cause a forfeiture of interest. Other courts, other states say no, that's not the case, especially if there's a for cause challenge. So some really good materials there. And miscellaneous items, well, again, it was a week-long series of presentations, wonderful programming, international issues as well, dirt lawyering, wonderful presentations there. Farhad Agdami and also Gray Edmondson in a breakout session talking about opportunity zones and and some of the nuances on the tax rules there. And with that, I see I've hit the end of my time, and those are the highlights of Hackerling.
Great. Thank you so much, Kevin, for those informative remarks. Again, if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, you can feel free to reach out directly to Kevin or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Three more quick items before I let you go. First, my next webinar is on Tuesday, March 11th at 8:30 a.m. featuring Galia and Tebi of Ruckelman PLC based in Tel Aviv and New York. And she's going to be speaking on Form 3520 reporting under the proposed regulations. So any attendees with foreign trusts or clients with foreign trusts, this program is sure to be informative. And I'll be sure to send out an invitation to this program in the coming days. In the meantime, I'd love to continue to grow this webinar community. So if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on X and Instagram at Jonathan on Money, and by connecting with me on LinkedIn, you could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.